BCE is one of the highest yielding stocks you can find on the TSX today, paying more than 12%. It's a monstrous payout, but is it a safe one? The company recently reported earnings, and I'm going to take a look at what the numbers say and whether the stock is a good buy in light of the results, and if the dividend looks safe. Revenue for the quarter was down just slightly by 0.8% to $6.4 billion. Its net earnings, however, rose by more than 16% to $505 million. But this was mainly due to lower impairment charges, FX hedging gains, and other non-recurring items. Its adjusted EPS was actually up less than 4% to 0.79. It wasn't a bad quarter by any means, as the company reported 151,000 net new mobile device activations, there were 34,000 net new retail internet subscribers, and a 19% increase in digital revenue for Bell Media, plus an 18% increase in subscriptions to its streaming service Crave, which now has 3.6 million subscribers. For 2025, the company isn't expecting much, if any, growth at all. It's forecasting revenue to be within a range of -3% to +1%. Essentially, it means that the best case scenario might be minimal growth. The good news is that it projects free cash flow to rise between 11% to 19%, which means more room for its dividend. But is that dividend really safe? Last year, its free cash flow was around $2.9 billion. If it increases by between 11% to 19%, that means investors can expect free cash to be somewhere between $3.2 billion and $3.5 billion this year. That's a good improvement, but it's also less than how much the company pays out in cash dividends over the course of a full year, which is $3.8 billion. It's looking like another shortfall this year, but that doesn't mean that the dividend will be cut. The company's forecast doesn't include any impact from its pending acquisition of Ziply Fiber, which is set to close in the latter part of the year. That's the big wildcard for the business today, how that plays out and how much money BCE may need to pump into that business. That will determine how safe the dividend really is and whether BCE may need to cut it to help fund its US growth strategy. Based on all the numbers and the company's guidance for the year, I don't see a reason for BCE to cut its dividend, at least not yet. For now, it looks safe, even though free cash isn't that great. Investors will, however, want to monitor that Ziply acquisition and see if there are any early signs of trouble from that. If there are, that could offer hints as to whether or not the dividend may be in trouble in the future. The dividend may be safe right now, but is the stock a good buy? BCE makes an intriguing option for investors. It hasn't been this cheap since 2010. But with it potentially spending heavily on US expansion, there are no shortage of question marks around the business today. It's still a good investment because with a yield this high, even if BCE does cut the payout, you may still be collecting a high rate of dividends. And if the company's financials improve and the Ziply acquisition pays off, there could be a ton of upside for the stock. This isn't the safest stock to be holding given the tailspin it's been on. Shares of BCE are down more than 30% in the past 12 months. But if you're willing to be patient and hang on for at least a couple of years, this may be a worthwhile stock to buy. BCE is a top telecom company in Canada, and that's not likely to change anytime soon. While it may be a bumpy ride for the stock in the months ahead, given how cheap it is, it may be trading at too attractive of a price to pass up right now. Overall, I think BCE can be a good buy, but it depends on what your risk tolerance is and how long you're willing to wait for it to pay off. That's a wrap for this video. If you liked my unbiased analysis, I don't have a position in this stock, please make sure to leave a like and subscribe for more videos like this. Thanks for watching.